Good morning, everyone. Thank you for attending the Place Your Trades Network Spaces to discuss commodities. This space is brought to you by TradeAbate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energies, metal, and now Bitcoin. You can trade these on the DOM via TradeAbate's main platform as well now. They're a great way to get exposure to the futures market with defined risk. You can use a link in my Twitter stream to go and get the TradeAbate app for free. I also write a weekly blog on markets that you can find at placeyourtrades.com. It's free, just sign up. And to welcome our guests, first we have Brent Johnson, who I'm sure everybody knows, but Brent brings over 25 years of experience in the financial markets to his position as CEO of Santiago Capital, where he manages $175 million for high net worth families via separately managed accounts and private funds. Brent enjoyed more than 9 years as managing director at Baker Avenue Asset Management, with a $2 billion asset management and wealth management firm with offices across the country. He was also a lead advisor for several of the firm's largest clients. Before joining Baker Avenue, Brent spent 9 years at Credit Suisse in their private client group. He got his start as part of the training program for Donaldson, Lufkin, and Janret in New York prior to moving to San Francisco. He joined Credit Suisse in the fall of 2000 when the bank purchased DLI. Next, we have Harris Hkuppy, who I'm sure everybody knows as well. Hkuppy has over 25 years experience in the markets and is founder of Praetorian Capital Management, LLC, an investment manager focused on using inflecting trends to guide stock selection and event-driven strategies. Mr. Kupperman is also the author of Praetorian Capital's public blog, Hkuppy's Corner, where he discusses his investment process and comments on hedge fund industry trends. He's also a contributor to www.kedm.com, an event-driven newsletter. He is also the chairman and CEO of publicly traded Magnolia Growth Group, a role which gives him a unique perspective into companies as both an operator and financier. And last but not least, we have TomKloza, who is global head of energy markets and co-founder of Opus. Opus is oil price information services. They provide price transparency across the global supply chain so that all stakeholders can buy and sell oil and energy commodities with confidence. He analyzed crude oil, refined products, and gas liquids for over 40 years. He briefly traded petroleum futures back in 1978 and admits he had no business doing so. He also writes commentary for MarketWatch and is a regular guest commentator for Bloomberg Financial and NPR Marketplace. He's spoken at industry gatherings in more than 100 locations across Canada and the US and sits on a number of advisory boards. So that is our panel. Thank you, everybody, for taking time out of your day to join us today. And we'll go ahead and get right to it. We'll start with Brent. And this first question is kind of a lot. There's a lot in it. So,
all right, I'll give you a big answer.
The Fed raising rates really hasn't put that much of a dent in demand, particularly in energy, although we've seen commodity prices obviously come down across the board since the highs of summer 2022. We still have energy that remains sticky as they try to bring down inflation. And some of the problems it's causing is higher rates. Also, it costs more to borrow, especially for commodity traders that finance large sums of money to buy and store commodities, which I think is kind of exacerbating the problem. So what are your thoughts? Do you think this backfires on the Fed? Do you think that, energy is continuing to go higher no matter what the Fed does? Have rates even filtered in yet? And is the Fed going to keep raising?
That's very easy to answer. It's such a simple question. I'm being sarcastic there. I think I would say in general, in answer to is it going to backfire on the Fed? The short answer is yes, it is going to. The question is, when is it going to? And I think for the last year, there's been many people predicting that the next hike was going to be the one that would bring everything down. And yet here we are, and it still hasn't happened. And I'm the first to say that I don't know. I don't know whether the next one brings everything down or not. I do think the Fed is still going to hike. I won't be shocked if I'm wrong on that, but my base case right now is that they are going to hike again. And part of the reason is, as you alluded, despite them, raising quite a bit, we haven't had the big crash yet, and we've seen, prices start to slow and come down a little bit, but we haven't seen a dramatic shift, and that dramatic shift hasn't shown up. At least it hasn't shown up in the stock market yet. I think it's showing up in the real economy more than it's showing up in asset prices. And I think in many ways, the Fed is probably behind the curve again, just like they always are. I always refer to the Fed as a reactionary agency. They're not a proactive agency. And I think there is risk to Powell's personal legacy to kind of, maybe you want to say, if you want to say the right thing to do would be to start, to stop raising and, maybe even start cutting. If that was the right thing to do, I think the risk to his personal legacy of doing that, I think you have to factor that in, because if he were to slow down, pause, or even cut, and then for whatever reason, inflation doesn't fall and perhaps ticks up again, he's going to look really stupid. And I just don't think he's willing to risk that. And I think I think he can keep raising, or at least not, pivot. And then when things get really bad, everybody will beg him to pivot. And then he can pivot with no risk. But I think if he pivots now, I still think there's risks to him personally if he pivots now. And so I don't know if that answers your question or not, but that's kind of how I see things right now.
No, that does. And then kind of along the same vein, there's a lot of debate on supply side versus demand side with the Fed.
Yeah.
Obviously they're trying to quell demand side. But given that, we have real supply side issues globally in a lot of commodities.
Yeah.
Do you think that commodity markets just completely disregard this, or do you think that they can,
Well, I think, yeah.
kill demand?
I mean, listen, the Fed can kill demand. If they come out in 3 weeks and take rates to 10%, that would kill demand. So the idea that they can't kill demand is completely wrong. They can, of course, kill it, but they're not going to come out and raise rates 400 basis points overnight. But the idea that they can't do it, I think people should get that out of their minds, because they absolutely can do it. Now the question is what are they actually going to do? And like I said, I think they're going to continue to raise rates, because I think that I think that rather than being stupid, I think they're arrogant. And I think they think that if they raise rates and things start to turn bad really quickly, that they can pivot really quickly and put some new policies in place and kind of save the system, right? So I think that the idea that they can't kill demand, I think they think they can, and I think that they can. And so I think that's what they're going to continue to do. I think they're going to try to continue to kill demand. Now, what I find interesting about energy is that I think if it wasn't for the supply issues, or just commodities in general, if it wasn't for the supply issues that you bring up, then I think commodities would be down a lot more than they are. Because we've had the fastest pace of Fed tightening, I think, in history, or at least one of them. And I think without the supply issues, prices would have reacted more than they have. So to me, it's kind of amazing that oil has kind of gone sideways for 6 or 9 months now, despite a very active tightening cycle by the Fed. And so I would have expected that to be bigger if it were not for the supply issues that you bring up.
And then let's talk about gold really quick.
Sure.
Knew that that's not a really quick subject either. But so gold once again, right, failed to break that triple top.
Yeah.
Those 2000s have been really hard to hold. So kind of what's going on with that? I mean, we have had even the debt ceiling headlines haven't managed to spook it higher. So what are your your views on gold at this point? I mean, it seems like if it's not going higher now, when's it going higher?
Well, so I've always kind of had mixed views on gold. I'm a huge gold bug, actually. You know, fundamentally, I am a gold bug. I think that gold is going to go much, much higher in the years ahead for many of the reasons that, you know, I think most people understand, whether it's, you know, financial, you know, shenanigans by governments around the world, the need to fire up the printers every now and then, you know, in a world where currencies being debased and hard assets cannot be debased, then, you know, they go up over time. You know, that said, I'm not somebody who thinks that gold's going to $5,000 tomorrow. And in fact, I think it's probably going to go lower over the summer. You know, I think, and I'm not sure on this, but I think that the U.S. is the only place where real rates are positive now. And so real rates tend to be a headwind for gold. Now that doesn't mean I think gold's going to $800 either. You know, and I'm not saying everybody should go out and sell their gold right here because it's going to crash. I'm just not planning on it paying off as soon as a lot of other people, perhaps in the gold industry, think they are. You know, and I think we have a situation with what's going on with the Fed and with the Treasury and the debt ceiling. I expect, regardless of what happens, it should be, in my opinion, a net drain on liquidity. And what I mean by that is for the last 6 months, Yellen's spending the funds out of the TGA, basically the Fed's checking account at the Fed, has really in many ways counteracted any of the QT that Powell has done, right? So he's raised rates and they've done QT, but Yellen's kind of been offsetting it because she's spending money into the economy. Now, typically, when you're not up against the debt ceiling, then when the Treasury is spending money into the economy, they're also simultaneously draining money from the economy by issuing bonds. They sell bonds, and in exchange for the bonds, they take cash back from the market and put it in their checking account, right? And so that takes liquidity away, and that has not been happening. But now we have a situation where, in my opinion, the debt ceiling is going to get resolved. And if it does not get resolved, then you're going to have a massive dollar shortage, which, in my opinion, would send the dollar higher and would be a definite headwind to commodities, including gold. If they do raise the debt ceiling, which I think they will, then what will happen is Yellen will almost immediately start issuing bonds again, because she will need to rebuild that TGA account. And when she does that, that should be a net drain on liquidity as well. So my guess is that if and when they announce that the debt ceiling has been raised, risk assets will bounce for a day or two on the initial news. But I think when we get to, you know, a couple days later or a week later, as the reality of the liquidity situation starts to be better understood, then I would expect those to roll over. And I don't think we're going to have a gangbuster summer in asset prices. So that's kind of, and it's for those reasons that I think gold will likely pull back. You know, it had this triple top. You know, I'm not going to sell my gold. I still own it because you never know. But I would expect it to pull back.
And then, of course, I have to ask, because everybody, it's a big point of conversation on Twitter, is all these central banks buying gold and what that may or may not mean.
Well, so my view on central banks buying gold is they buy it for the same reasons that other people buy it. I mean, in my opinion, central bankers are not stupid. I've said this before. I don't think they're stupid. I think they're arrogant. And they know that fiat loses value over time. And I think they know that gold doesn't, right? Gold tends to hold its value over time. So they hold it as an insurance policy, just like everybody else. There's another reason I think they hold it, and that is if they hold it, they can control it. You know, and, you know, for the same reasons they hold people like Julian Assange in prison, because they want to control him, right? They don't want him out there causing trouble. And so I think central banks in some ways buy gold because if they own the majority of the gold in the world, then they can control the gold market. And then finally, I think they do it because they know that to solve these problems that the whole world has, this is not just a US problem, that currency is going to have to get debased. Now, whether it gets debased over the next 6 months, the next 6 years, that's probably up for debate. But the fact that it will be debased is heavily certain by just looking at history. I think a lot of people say, oh, they're buying gold because they know that the Fed is going to have to print all this money. Well, no, they're buying gold because they're going to have to print their own currencies, right? They're not buying gold as an insurance policy against the dollar, although I think that it does do that. I think they're buying it just as much as an insurance policy against their own policies and their own currencies and their own economies. Because they know that at some point they may have to use gold to bring confidence back to their own economies and their own currencies.
That absolutely makes sense. And we'll come back to Brent. We're going to go, I usually do this in a round. So I still have more questions for you. We'll come back to you. We'll go to Cuppy next. Obviously, we got to talk oil, right? So I know you recently wrote something in your Kadim about oil positioning, and we've really seen lackluster participation for months now. So what do you think it's going to take to get people interested in this sector again?
Well, I don't know. I don't think anyone's really interested in oil. I don't really know. What I do think is quite fascinating is that in the last month, you've had something like 300 to 400 million barrels of oil dumped on the market, and this is all paper oil, and it's running at 10 million barrels a day. I mean, you basically had the entire SPR worth that took them almost a year to dump, and they did it all in like a month. And oil took it all and kind of held that 70 level. And I'm going to see huge draws today. I think you're going to see huge accelerating draws. I'm always baffled that the vast majority of people, following oil, they forget that most of the oil coming from OPEC comes from the Middle East, the seaborne oil, and that takes about 6 weeks to get to here. Or if it's going to India or China, wherever it's going. And so it takes a bit of time for this to show up in balances. It's all on the water right now. And you're going to see large accelerating draws. And, you're going to have large draws, and then you have all this paper supply, and that paper supply eventually becomes demand. And I think it's going to fix itself, and it's going to be rather explosive. And so, I'm pretty happy, honestly. I'm just kind of watching and, focusing on my farm and getting some surfing in. Time's on my side.
Well, and I was looking at the last U.S. drilling productivity report, right, for new well production and legacy oil production. It shows that shale is massively slowing down. So, what does this mean for U.S. companies? You think we'll see more mergers and acquisitions as people try to, because they're not out there spending money, for sure, right?
I mean, there's a couple of reasons they're not spending money. I mean, the most important of them is that if you get paid $70 in the front month and, you're going to be producing for a couple of years, you can't go hedge it in the back months because you're in the 60s. And it's just not profitable, except really the best parts of the Permian. And they're running out of that acreage. And why would you use your best stuff at a low IRR? I mean, you want to hold that for when oil is above 100. What we've also seen in the Permian and many other basins is that the 2023 vintage is tracking worse than the 2022 vintage. I'm talking about production per lateral foot, and 22 is tracking worse than 21. I mean, it shows you that they've used up tier 1 locations, and that's despite the fact that the technology keeps getting better and they keep loading more sand and everything else. I mean, they're using up the best stuff, and so it's not just the number of lateral feet drilled and the number of rigs in the field. It's that you're starting to see the production kind of roll off per foot. I think you compare that to what you're seeing in offshore, where they're just going crazy. I mean, Petrobras just locked in a 7th generation rig from Noble, and it's $495 a day. That's a new cycle high. But the more important part is it's 2.5 years. I mean, you're talking about $250 million of EBIT, roughly, to Noble on that contract. I mean, it's kind of funny because you have a company like Valaris where they're valuing the company for less than 200 million a rig, and you have Petrobras telling you that they're willing to pay 250 for just 2.5 years. Like you literally make your whole EV back, and you still own the rig when it's all said and done, based on pricing. I mean, one of them is wrong, one of them is right, and fair disclosure, I own a lot of Valaris. I think I'm the one who's right, and Petrobras is agreeing with me today. So I think you're going to see a lot more spending offshore just because that's where all the big discoveries have been. That's where the high IRR wells are. You don't have the decay curves that you have to just keep drilling and you never have any cash flow. I mean, that's the problem with all of the shale. You just keep drilling holes in the ground. You never have any cash and dividends or anything else because as soon as you stop drilling, it all trails off. And it's the same offshore, but you have to keep drilling. But it trails off much slower, and they're much better wells. And I think you'll see in the future a lot of the baseline production is going to be growing in the offshore sector, and then you'll see shale kind of ramp up when oil's above 100 and kind of ramp down again. But I don't know. It's kind of working pretty well. The big surprise, like I said, is that over the last month and change, you've seen specs just dump paper on the market, and I don't think anyone expected that. I don't think people expected Iran to dump their supply of floating storage, about 100 million barrels. Obviously, you've seen a bunch of other weird things happen in the market that have just been this overhang, but that overhang is all clearing. I think we're in a really good spot now, and I wouldn't be surprised if OPEC, when they meet in a week and change, that they don't, one, formalize the cuts, but two, maybe even do something else. I think you get fireworks setting up this summer and fall.
Well, yeah, I mean, the Saudi oil minister just came out and said, he thought you're going to be ouching to the oil shorts, for the third time. But what are your thoughts on Canada? Because I know you have your eye on a company there. If you want to talk about that a little bit.
Well, I mean, I own some Journey Energy. I own a couple percent of the company, so yeah, fair disclosure. Look, I think you can buy barrels anywhere in the world, and in the case of Journey, they, on a flowing production basis, on a PDP basis, I mean, you name the metric, Journey's mispriced, and I like buying mispriced stuff, especially in a pullback in a long bull market. And I like Alex Verge, who's running Journey. He saw the price of oil drop, and he pulled back on the drilling. And he's going to put his capital this year into power generation because the IRRs are better. If the price of oil goes up, he'll go back to drilling. I like that sort of flexibility and mindset, and that's kind of why we own a lot of shares. In terms of Canada itself, I'm kind of worried that you take on way more political risk than most people think is possible. I mean, if the UK could do excess profits tax, and I'm terrified of what Trudeau is going to do. So everything comes with a cost also, and that political risk is a real cost.
Absolutely, having lived there, I would say yes, at least for now.
But it makes you start looking at places where we've never gone. I like to joke that I don't want to put my money in places where you can't drink the water, but a lot of these countries are actually doing better than the Western countries in terms of property rights and protecting investor assets. And I don't know. I think the differential in valuations should probably close, and some of these places that you'd think of as being crazy might not be as bad.
No, yeah, absolutely. Like that makes sense. I mean, we've seen a lot of activity on the west coast of Africa, and obviously in South America as well. Are you somewhat worried about the leftist governments in South America right now, as far as oil production is concerned?
Well, leftist governments usually don't incentivize oil production. I mean, it's good for me if I own oil somewhere else. It's probably not good if you are in those countries because they have a long history of destroying production. I don't own any Petrobras or Ecopetrol. It might work out. It might not work out. I don't really know. I mean, they're obviously cheap. They're cheap for a reason, and I'm of the view we run a pretty concentrated book, and I don't like making mistakes. Mistakes are expensive. I'd rather bet on pretty sure things with no downside, and those both have a lot of downside in my view. So We've kind of looked at them and have some friends that own them, but this is not for us.
No, that makes sense. I just have to ask because it's a big subject of conversation on oil Twitter.
It is.
um, all right. Well, I'll come back to Cuppy. Let's go to
Sure.
Tom and talk about the product markets for a little bit here. So we've been seeing some really big product draws lately. We have distillates again at 18% below the 5-year average, gasoline 8% below the 5-year average. We had a huge crude draw. Obviously, this week we have refinery utilization rates around 92%. So how much of today's, well, first, how much of today's number is gearing up for Memorial Day weekend? And then, how much is this domestic demand versus exports? In other words, what is the product demand sector looking like right now?
Well, good morning, first of all. And I have to say, I'm back in New Jersey, where we're not only prohibited from pumping gasoline, but we're incapable of actually pumping our own gasoline. So keep that measurement in mind. It's setting up really good for refiners right now. I think refiners probably got hammered quite a bit in the last 40 days. But the reality is they now see gasoline, selling for 30 something dollars over the price of most crudes. We're exporting quite a bit of gasoline. And you mentioned South America before. One of the things that people don't realize about South America is they have less refining now than they had 10 years ago. 10 years ago, when PDVSA wasn't necessarily in the position they are now, they were refining maybe 6.5 million barrels a day of crude. Now they're only refining about 4.4, and the population is growing. So I would suggest that Latin America is going to continue to take most of the excess that's produced by our Gulf Coast refiners. As far as gasoline goes, I mean, this is the kickoff to the driving season, but it's a little bit more mythical than real. The reality is this week is probably a little bit of a dress rehearsal for high gasoline.
Oh, did you drop off?
I was getting the phone. No, I'm still here. You there?
Yep, got it. You're
Okay.
back.
No,
You just
yeah,
cut
I
out
was
for a minute.
getting a call coming in there. I'm sorry about that. But in any case, it's more mythical than real right now on the driving season. The real driving season is, let's say, from June 20th, around the solstice, to when schools go back in the South and Midwest in August 10th. And you could see gasoline demand in that period about 9.5 million barrels a day. I would submit that today's number is a little bit of an overstatement of where demand was last week. It's only, I think, the fifth or the sixth time this year that we've been over 9 million barrels a day. The one thing I would look at when I pretend trade is I like to set up for diesel now. You've got gasoline fetching a price, anywhere from 5 to 30 cents over diesel, so that the yields for diesel are going to go down and gasoline yields are going to go up as refiners ramp up further. So I think that particularly in the last third of the year or the last half of the year, it's looking like diesel will trade 35, 40, even $45 a barrel above some of the benchmark prices for crude. So it's a good report, for refiners down the road. The other thing you have to watch, and again, I looked at this, if truth be known, I would say that April high of 289.43, I believe it was for RBOB, is probably the high of the year. But I think you can make the case for maybe a second higher high in the second half of the year. And I would make that case coming from Fort Myers, where I live, about 6 or 7 months of the year. We're very familiar with tropical weather down there. And I looked at it, and the refining capacity the United States had in what I would call Hurricane Alley, from Corpus Christi up to Mobile, was about, I've got the numbers here. Let me look at this. We did add about 400,000 barrels a day of capacity this year, but now about 9.7 million of it is at the Gulf Coast, and particularly in the coastal portions of the Gulf Coast. We only had about 8.1 million of refined products capacity in that stretch of real estate back in 2005 with Katrina. So these are now billion-dollar plus assets. The companies are going to protect them, and that means that if you get probability cones in the Gulf Coast in July, or probably more commonly in August, you're going to have market rallies, and you're going to have very significant rallies for refined products, gasoline and diesel and jet fuel in the second half of the year. So I think this is a summer of sizzle. I could use that term and say that when you have
I like that
yeah, when
term.
you have those very high temperatures out west, like we did in 2021, the refineries there were not built to operate with ambient temperatures of 95 to 100 degrees in places like Washington and Montana. So stay tuned. I was a little bit bored here a few weeks ago. Then I got in the car, drove up to New Jersey, stopped at Buc-ee's, and now I feel like I'm an expert in gasoline.
Excellent. And that's what another thing I kind of wanted to tie into this. So we're seeing, as far as this, I was going to talk to you about, diesel or actually distillates, jet fuel, et cetera, because, so far, I mean, airlines are looking great. Last week, the stats came out. We were plus 0.4% week over week and plus 1.2% versus the same week in 2019, which was obviously, the high of all time. And we had United Airlines CEO Kirby come out and say it's going to be the busiest Memorial Day weekend air travel ever with 2.9 million passengers. That's 16% higher year over year. And he also said it's going to be a busy summer. And you have that. But then on the opposite side of the spectrum, we have the trucking demand problem, right? So do you see this improving over the summer?
I think that diesel, I mean, you're talking about what's been characterized as a freight recession, and stuff is just not moving across the country like it was in 2021 or 2022. So I don't think it's going to be demand inspired. And, we're in the month right now globally. The month of May is the lowest month for distillate demand on the planet. So I think that probably what happens are constrictions in supply. We need to build inventories of distillate and particularly diesel, obviously, in the off season. And I don't think Europe, by any stretch of the imagination, is in the clear for next winter. I mean, it's still a crapshoot as far as whether they have enough LNG and enough natural gas and enough diesel to handle a typical winter as opposed to the winter that wasn't last year. So I think that if you're looking for reasons for diesel to trade higher, ULSD or gas oil, I think you're probably looking at the supply side and not necessarily on the demand side. Let's face it right now. When your previous guest was talking about the lack of participation on the long side in futures. I look at that and I go, maybe we should do what they do in high schools and grade schools now and give participation trophies for people that go long or go short in futures, because it has been very, very quiet. But I do think that those folks are going to come back. This morning, and I'm privileged to be able to read the best analysis from the best banks. And there was a report today from Citi, which is a little bit bearish. And there's a report today from Goldman Sachs, which is quite bullish. And they're looking at a 30.3% increase across the S&P GSCI in the next 12 months. That's a stunning prediction. And, we all love to make fun of Goldman, but, they have some real smart people there. So I think that's something we need to take under consideration.
Yeah, and actually, if you look at gas oil, it has the same problem that crude does. Since you brought up gas oil, is that participation is, there's none, right? And so every time that we've had pretty much participation this low, we've seen a huge rebound.
Yeah,
So
I think
we'll
Tracy,
see the history
I
repeats.
think you have to go back to the pre-2003. You know, to me, oil as an asset class really took off with the Iraqi war in 2003. If you look at open interest numbers and participation numbers before that, you know, it was just the province of a few middling traders in New York. But since then, I mean, we saw it subsequently blow out to where, you know, in 2008, you had all of the banks and, you know, various divisions trading it. But now, you know, we're going back to numbers that we haven't seen. And, you know, passive income and passive investment tends to be on the long side. But it hasn't been going there because of this big perceived macro risk these days. So at this point.
All right, we'll come back to Tom. Let's go back to Brent. So the other day we were kind of talking, and you actually mentioned that you were starting to get into grains. So what are your views on this sector, and what are you seeing that's kind of made you look into the sector again?
Yeah, so it's funny because I've been watching the sector for a couple of years, and I remember it was 2 summers ago, you know, the grains had just made a huge move higher, and I completely missed it. And I had been watching it go higher, and I kept thinking there was going to be a pullback, and there just wasn't. And then they went up almost exponentially there. And then last summer they were still pretty high, and I kept telling myself, if I just be patient, you're going to get an opportunity, right? And sometimes the hardest thing is when you start to develop a thesis that you want to invest in, but the price just isn't where you want the price to be. And being patient and waiting for it is one of the hardest things to do. And so I believe in the years ahead, we have the potential for a food crisis. And for a number of different reasons, which I probably can't go into all of them now, but and so I've wanted to be kind of long that space, but prices had risen so much I didn't want to buy in there. So I just I just kind of sat on my hands and watched it, and sure enough, you know, the prices started to come down, and then over the last, call it 2 or 3 months, I don't know if collapse is the right word, but they've you know, like oats, wheat, corn, soybeans, they've all had a significant drawdown, and so the not only did the price come way back to kind of, I don't know, kind of a historical average range, but the sentiment on them is just totally wiped out. The relative strength on the charts is, I mean, the charts are ugly, right? And so, but we're back down to these prices, and everybody hates it. And part of the reason the prices have come down so much is, for the last year, we have sort of had the perfect scenario for a bumper crop. In other words, the winter, and this kind of plays into Cuppy's thesis as well. Like the last winter was kind of unusually warm. We didn't have, you know, the really, really hard winters. And so, you know, growers were able to plant their crops earlier, and, you know, the yields so far are coming on really strong. And then, you know, there was a lot of fear. Part of the reason that the prices had run up over the last couple of years was, you know, the situation with Russia and Ukraine, and, you know, Ukraine produces a huge amount of grain, and so was that supply going to get pulled off the market, or was it going to come to market? And they just, over the last couple of weeks, that grain is going to. There was a thing, I don't remember the exact name, but there was a Ukrainian grain deal or something that was going to get renegotiated. Well, that got pushed down the road a couple months, and so that grain is coming onto market, and so that's, you know, so basically we've had very good supply, and the overwhelming supply has pushed the price down a lot. And so, you know, when last week, when I saw the RSI, the relative strength on these were just way down. The sentiment, there's some sentiment indicators that I follow, were as low as I've ever seen them. And I've never seen anything I've ever bought when the sentiment was that low. I always at least got a bounce out of it. Now, whether it turns into be a monster trade or not, that's I don't know. And I think I'm probably a little bit early in buying these. It wouldn't surprise me if you know, if we continue to have good weather, and we can, you know, the yields on the crops over the summer are good. It wouldn't surprise me if prices go lower. But what I don't think is going to happen is, I don't think we're going to have another winter next year as good as we had this last year. I don't think oil prices and energy prices are probably going to stay as low as they were this year, and that's a big input into prices. I don't think that tensions with Russia are going to get better. I think they're probably going to get worse. I don't know that all of the all the grain that came to market from Ukraine and Russia this year is going to come again next year. And I think it probably is not. And then the other wild card in there is later this year and into next year is supposed to be an El Nino year, which is basically I'm not a climate expert, but typically in El Nino years you get extremes in climate, and it could be extremely hot or extremely cold, but I just don't think we're going to have the same level of, or I don't think we're going to have the same lack of volatility in climate next year that we did this year. And so I think when you put all those things together, and then finally, I think, unfortunately, and this, I don't like saying this because I don't want it to happen, but I think it's more likely than not that, military conflict increases rather than decreases over the next couple of years. And for all of these reasons, I think we can get into a situation where supply of food is limited. Demand almost never falls because people got to eat, right? And so I think in the next couple of years we could be in a situation where prices are right back where they were a year ago or 2 years ago, and probably even higher than that. And so I want to be involved. And so even though I think I'm probably a little bit early, I'm involved now. And if things rocket back up, in the next 6 months or a year, I will be participating in it.
Yeah, and I also think that, this push for like sustainable aviation fuel and biofuels that include feedstock,
Yes.
right? The Biden administration wants to produce 3 billion gallons a year from less than 16 million right now. So that feedstock comes from, agriculture.
Yeah.
And so, if we have these big push, we're going to be burning food for energy.
Yeah. Oh, and I forgot to mention that wheat has, I don't think it's its biggest speculative short position in history, but it's getting close. It's as big as it's been any time over the last 2 or 3 years, and that position that it had 2 or 3 years ago was the biggest ever, and we're getting pretty close to that level again now. So when you combine all of the potential positive catalysts with a massive short position in something like wheat that the whole world needs, I just see the potential for a monster reversal, and so I wanted to be involved. So that's my thinking there.
Excellent. And then, of course, I know I said we weren't really going to talk about USD, but it's kind of impossible to talk about commodities without at least bringing it up.
Sure.
So do you see a situation potentially if the dollar moves higher, commodities just ignoring it as they did last year? Or should we really be, keeping an eye on this where the dollar is going to go, there's a situation where the dollar may go so high, obviously it'll kill everything.
Yeah, well, I think you always have to consider the potential for a spiking dollar to just crush demand and therefore be a hindrance to commodity prices. I'm not saying that that's definitely going to play out. I just think you can't ignore it. And so, especially with the Fed hell-bent on, the Fed is telling you they want to kill demand, right? So to me, it's kind of funny that for years people say don't fight the Fed and buy equities. But then when the Fed is telling you we're going to tighten, there's going to be pain and people are going to lose their jobs, everybody wants to fight them all of a sudden. So I think you have to at least consider that. It's also why I'm kind of more focused on the grains part of the commodity complex as opposed to kind of industrial commodities, because it's really hard to kill demand for food. To me, it's much easier for them to kill demand for industrial commodities than it is for them to kill demand for food. And so that's kind of why I'm focused there. But, if the dollar does go higher, I think it will be a headwind. Now, whether it's a headwind enough to stop price rising, I think that's more, you got to kind of get down into the nitty gritty of the individual commodity and the individual industries. But, going back to oil really quick, for those who don't kind of follow commodities that much, one thing I would have people just kind of consider and put in the back of their mind is that there's few things that are as inflationary or deflationary as the price of oil. You know, the higher the oil price goes, kind of the more inflationary environment that's going to be, and that's not good. But the same token goes, you don't really want a really low oil price either, because that's deflationary. And so, you know, right now, and this is kind of why I think markets have kind of held up, is, you know, at this between $70 and $80 range on oil, that's kind of the sweet spot. You know, it's not too inflationary, it's not too deflationary, but my guess is it's not going to stay there. And so, you know, as it moves, just kind of keep that in mind, how oil impacts everything.
Well, yeah, I mean, energy is, you can't do anything without it.
Right.
So
Exactly.
yeah, you know, so it makes everything more expensive,
Right.
whether, you know, manufacturing, farming,
Yep.
anything.
Yep.
So, all right, we will, next up, back to Cuppy. I want to talk about, I want to see, you haven't talked about uranium in a while. And we have uranium, you know, U.S. is looking to ban Russian uranium. That's about 14% of current imports. And our domestic production has fallen to almost zero. So do you still like this sector? Are you still involved in this sector?
Yeah, absolutely. I mean, a lot of these sectors, you put them on and they just trend. And it's funny. You have this funny oscillation, like it gets in the news, everyone's excited about it, everyone's tweeting about it. And then it kind of goes quiet, and then something happens and it gets exciting again. And look, I bought my uranium when I was roughly 31. No one's really talking about it, but every couple of days, the spot price ticks up another 50 cents. We're at 6 or 9 month highs right now. We're at 55. We're almost about to take out the multi-year high. I mean, this is when you should get really excited, when no one's talking about it, and it's grinding higher. And this isn't speculators buying it through the spot vehicle. This is actual utilities that need actual uranium, and they're having to pay up for it because there's a deficit. And you know, there's more supply than there's more demand than supply. No, I think it's going to work surprisingly well. I think it's a very geopolitical commodity, much like oil. I think people aren't paying attention to the fact that China just locked up a huge amount of Kazatomprom's offtake. Russia is locking up one of their new mines. Kazatomprom, you know, it's Kazakhstan, you know, they're kind of landlocked and stranded, and it's hard to get the uranium from Kazakhstan to where the West needs it. But in very rough numbers, Kazakhstan's about 60% of the world's supply. Russia's, you know, around 15. So we're looking at 75% of the world's supply that isn't going to come to market. And you know, if we don't block the Russians, and I think Putin just kind of wants to be a martyr on this. I mean, they're just going to turn off the supply to us because it's what you want to do if you're having a Cold War and you want to hurt the other guy. And I'd assume that your Russian uranium cuts off pretty soon, and you know, you're going to have a big chunk of the world's reactor fleet in the West, and none of the uranium comes from the West, outside of a little bit from Canada. And I don't know how this solves itself, but it's probably going to lead to higher pricing because supply-demand deficits and geopolitical volatility is really good for price. And I think we're going to see the price respond quite aggressively over the next couple of quarters. And I still own a ton of mine, and I should point out that if you ever like to buy uranium, you want to buy it when it's at a discount, and the Sprott vehicle's at a low teens discount right now. It's a good time to buy then.
And then are you, obviously, the West is not going back on green initiatives, despite the energy crisis last summer, and despite the fact that we might have one again. They don't seem to have learned their lesson, right? So are you looking at any of these metals, like base or industrial metals, copper, lithium, or anything involved in kind of renewable batteries, et cetera?
No, I mean, we're about to have an energy crisis. We're about to have a monetary crisis. We're about to have a fiscal crisis. I mean, green energy is something nice to do when interest rates are zero and the economy's doing well. There's a lot of extra money sloshing around, and you can have all these grifters kind of steal money from the government and force these things down on people. Like when you're entering a crisis phase, this sort of stuff goes away. I like to joke that woke dies past 4%, and these are all just woke projects. They have terrible energy return on energy, EROI. You know, that they're very expensive energy. At some point, people are just going to want to burn coal because it's really cheap and it works. And so, no, I'm not putting much energy into that. I watch copper quite closely because it's a good proxy for what's happening in the global economy. And copper rolling over is kind of scary. But I also understand that with interest rates where they are, a lot of the big projects that would take copper are slowing down. They're going to finish the existing ones that are half built, but copper demand looking out 6 months is probably going to slow down because they're not going to finance the next set of projects. But I'm definitely not touching any of this stuff. I mean, lithium's going to have a glut for as far as I can see. I mean, they're just building so much of this stuff. That's the great thing about commodities. They have booms and busts, and the bust lasts like a decade and liquidate everyone, and then you have a boom. And so I'm focusing on the stuff that's about to boom, like uranium and oil.
No, that absolutely makes sense. I mean, it depends what you want. I think it's going to be, if we have another energy crisis, it's going to be hard to sort of build out all these EVs without, with energy prices really high.
Well,
But
yeah, I mean, EVs only work with massive government subsidies, and even then, they don't really work. I mean, the honest truth is, like, just like your cell phone battery starts to degrade after a couple of years, the same thing happens with your car battery. And so you're looking at, a third, 50% of the value of the car that's being replaced every few years. Like, I don't see how that's sustainable. It makes no sense. I think, having a little EV golf cart is great if you're going to live in a city and not drive much. But a lot of people drive a lot, and it's just not it's just not the right way to do things. And I think people have also forgotten, just how much, if you're going to focus on carbon, which has never been one of my focuses, but if you're going to focus on carbon output, EVs actually consume a ton of carbon to build the thing. It takes a couple of years of ownership before you're actually coming out ahead of an ICE vehicle. So, I mean, people like to believe they're loading up on electricity, but most of that electricity is just, it's coming from coal. Like the whole thing is just this weird thing that only can be invented by government bureaucrats. Like it's just, I don't think it's the future, quite honestly. And when you look at an ICE engine, the technology keeps getting better, fuel efficiency, everything. I think that's going to remain the main mode of transportation.
well, yeah, I mean, and to support all this, we'd have to redo the whole grid, right? I mean, if everybody went EV tomorrow, we'd crash the grid entirely.
Yeah. Or you could live in a place like Puerto Rico where the power only works a couple days a week. Like I can't get an EV. I won't be able to charge it up.
That's nuts. Oh, all right. So, and then back to Tom, and then we'll do one last round of your final thoughts. But uh, have you read up on this this new EPA proposal? And it's basically set to shoehorn the natural gas power plants. If so, can you explain it a little bit? And do you think it's going to pass?
I'm not that familiar with that. I'm familiar with New York State, which I guess is trying to do some things and get rid of gas stoves and whatever, but not familiar. I do know that EPA, I think today dropped the request or within the last 24 hours for having E-RINs, which are the renewable identification numbers that you get from using ethanol or renewable products, and thankfully they're not going to go for the E-RINs. But on the natural gas side, and not so much.
And then what are you seeing as a whole for, obviously obviously natural gas prices are back on the floor where they've been for a very long time. Everybody's kind of trying to pick a bottom. How do you see this industry? Do you think that, we saw 16 rigs come off for natural
Right.
gas, I guess the week before last week. And so do you think that's what it's going to take? It's basically, they're just going to have to shut in production because it's just not
Yeah,
affordable.
I mean, I think that most of the people I talk to believe that production costs are somewhere in that $2.40 per million BTU range, so that we are seeing a lot of that shut in. And I think, there was again, a note from Goldman. I'm giving them a lot of credit here, but they had a report about, or no, it might have been Bank of America. They all blur. But they were talking about a better upside for natural gas companies than oil companies because of the shape of the forward curve. And the number is much, much higher for natural gas further out. Again, if you believe, like I do, that we might have an active tropical season this summer, it wouldn't take much to shut in a lot of offshore production and really energize that market. And your previous guest was talking about the lack of a likelihood of seeing a winter like last winter, which I think was probably record heat in the northern hemisphere. So I think that natural gas is probably a good bet. I would just stay away from those double and triple long ETFs that can, I think there's one called Boil that Bloomberg has, and it can boil your blood really quickly.
Yeah, that's not a market you want to be in, a triple levered product for, a double
No,
levered
it's like
product
you need a
for.
little bit more action than in the commodity space. Let's go with triple or quadruple leverage. No, I don't think we want to see that.
And then as far as what is kind of the LNG sector looking like as far as, exports are concerned, and what are we seeing as far as volumes going to, we sent a ton of LNG over to Europe last summer when they were having a problem. Do we see this trend continuing?
I think it continues, and it's one reason why I call North America and I call the Middle East. We're the privileged continent; they're the privileged part of the world. The price of natural gas in the United States is that you can cut your costs on refining products by something along the lines of 20 or 40 cents a barrel. And if you look at European refineries, particularly the complex refineries that have to buy their natural gas, from by hook or by crook, it's much, much tougher for those operations to operate at a profit. And that's true in Southeast Asia as well. So, natural gas is probably the biggest reason why North America is a privileged continent. Some of the projects in South America, I was bemoaning the fact that we don't have much refining there. Well, we don't have much refining there because they're going to have to import their natural gas as opposed to home grow it. And that is a real, real game changer. It's one of the reasons why we don't have the Hovensa refinery in St. Croix anymore. They had to boil butane or some other hydrocarbons because they did not have natural gas to use. And that was the case for the Come By Chance refinery up in the Canadian Maritimes as well.
So you're looking positive on LNG and
Yeah, I
U.S. nat
don't
gas.
follow it, but from the periphery, Tracy. So I need to be cautious. I don't want to be the most dangerous man in the world, which is the articulate incompetent.
I get it. Thank you. All right, and then the last round, really, just want to go. We'll start with Brent. Your final thoughts, and then or anything you want to mention that we didn't mention, and what we kind of should be looking out, as investors over the next, I don't know, 6 to 24 months.
Yeah, so I've kind of been in the camp all year that this is a year to kind of be careful and don't get too far over your skis. To me, it's an incredibly uncertain time. I've been doing this for almost 25 years, and it's the most uncertain time I can remember. So, I just keep that in mind. And I am of the opinion that in the short term, prudence is important. And I know in high risk environments you can make a lot of money, but you can also get wiped out. So I wouldn't be all in on any one thing right here. And if you are all in on any one thing, I would definitely have at least some powder dry on the side that you can use in the case that goes against you.
Excellent advice. Cuppy, your final thoughts, or talk about something that we didn't get to talk about and what we should be looking ahead to.
I want to talk about TLT, and I know I sound like a retail hiker talking about TLT as opposed to the 10-year or whatever else, but I'm just going to be a retail piker and say that TLT is just slowly melting down, and I think under 100, it's kind of sets off fireworks. I think they went out there and got panicked at a regional banking crisis, and they tried to prop up some banks to do some really idiotic things. And I think they run the risk, if they pause and add liquidity, of blowing up the entire yield curve. And I think the far end of it is going to have a heart attack. I mean, when you think about it, you have Fed funds in the fives, you have CPI in the six, and you have deficits in the sevens. I mean, it doesn't make any sense. And then you have the 10-year sitting there with a three handle, or I guess a low four. Like it doesn't make any sense, Like the whole thing is inverted and weird. And I think there's a not small chance that the 10-year readjusts itself, and it's maybe a 7 or 8 handle. And if that happens, they don't have to worry about Silicon Valley Bank. You can be worrying about J.P. Morgan and Bank of America. I think that's really the risk, is that they lose control of the longer ends, and no one really seems to be talking about it. But once they get this deficit thing sorted out, Yellen's got to, do a trillion and change of issuances, and that's a lot of weight. And I think that sort of weight, especially while tax receipts are starting to roll over, that's a lot of weight on a market that is already sort of wobbly. And I don't think people are paying enough attention to that. And what happens when you get to the world that I see in the fall, where rates are going higher on the long end, oil's triple digits, CPI, which seems to have bottomed, is starting to wake up again. Whether it's rental, housing rentals, like a third of it. A bunch of these things seem to have bottomed in Q1. They're starting to show a little life again. Plus, labor is still quite strong. What happens if, the CPI starts picking up, oil starts picking up, rates start picking up? What's J-Powell going to do? Is he going to save the banking system or save the Treasury? And I don't really know what's going to happen, but I think we have a train wreck coming this fall, and just be prepared for it is all I'd say. And when I say be prepared, be in liquid names and be ready to do a lot of trading. I think it's going to be fun. I've been waiting a year and change for some fireworks. I really like fireworks. But anyway, just be careful. That's all I have to say.
Excellent. Also excellent advice. And Tom, your final words and what we should be looking to, or something that we haven't talked about that you would like to cover.
Well, I'd probably like to close and suggest everybody watch global refining. You're going to hear a lot about big new additions to global refining and think, oh my goodness, are we going to go from tight supplies to glut? The reality is that most of these plants aren't going to have meaningful production of gasoline or diesel until 2024 or perhaps 2025. Everybody picks up the story that Nigeria is commissioning a 650,000 barrel a day refinery. It only has one crude train, which is really, really odd. It's like driving a car with one huge, humongous cylinder. And, this week we heard reports that, oh, well, Mexico is going to be opening up the Dos Bocas refinery. The reality is that they won't have the natural gas supply or the operations ready until 2024. And that's true in other parts of the world as well. And yet we will see the closure of the U.S. refinery, the Lyondell refinery in Houston, at the end of this year. So I think, and I don't own any refining stock, so I'm not talking my position here. I think refined products are going to be very firm relative to crude oil, and maybe, and I think RBC in a note last week suggested this, you're going to have the tail wagging the dog with stronger products prices pulling up crude to eventually get to some of the numbers that some people suspect we're headed to.
Excellent. Well, thank you everyone for being here today. Thank you to our speakers for taking time out of their day to talk to us. I really appreciate it. Please follow Place Your Trades, Twitter, and all the guests, of course, up here. They all tweet excellent information.
I just tweet memes.
I know, but they're good memes. But
You
they're
won't
good
learn
memes.
anything from me, but hopefully you'll laugh.
His speed is excellent. So again, go to placeyourtrades.com, sign up for my blog, check the site out. You can get the TraderMate app there also. Again, I'll post a link in my Twitter stream so that you can sign up for that. And I guess that's it. Thank you, everybody. And we will see you next Wednesday. Thank you, everyone.